What is diversification and how does it affect advisors? Have you ever heard of the term diversification? It is an interesting concept that can have a significant impact on investment strategies and financial planning. Let's break it down and see how it affects advisors and their clients. Diversification is a term introduced by investor Peter Lynch. It describes the negative consequences of over-diversifying an investment portfolio. This happens when an investor adds too many similar assets, which can lead to lower risk-adjusted returns. Instead of improving a portfolio, diversification can actually worsen the balance between risk and return. In financial planning, the goal of portfolio diversification is to reduce risk by spreading investments across different asset classes, sectors, or regions. However, when an investor goes too far, they may end up with too many similar funds or securities. This can create unnecessary fees and make it harder to manage the portfolio effectively. When advisors face diversification, they encounter several challenges. One major issue is increased complexity. Managing a portfolio with too many overlapping investments can complicate monitoring and rebalancing efforts. This can lead to inefficiencies that advisors must navigate. Another problem is that diversification can dilute potential returns. When investments are spread too thinly across many holdings, some may underperform or have similar risk exposures. This can lead to a situation where the overall performance of the portfolio is not as strong as it could be. To avoid diversification, financial advisors need to find the right balance between diversification and simplicity. They should conduct thorough portfolio reviews to identify any overlapping or redundant holdings. By selecting investments that truly add value and are uncorrelated, advisors can optimize risk management and returns. Managing costs is also essential. Advisors should limit the number of holdings to a manageable level while still achieving diversification goals. Educating clients about the difference between beneficial diversification and diversification is key to aligning expectations and investment strategies. In practice, effective diversification means allocating capital across distinct asset classes such as stocks, bonds, real estate, and cash. It also involves considering geographic and sectoral differences. Advisors should focus on increasing the quality of diversification rather than just the quantity of holdings. In summary, understanding and avoiding diversification is vital for financial advisors. It complicates portfolio management, increases costs, and can lower client returns. By mastering the art of financial planning, advisors can create portfolios that balance risk reduction with efficiency and clarity.